The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Investors turn defensive as some of the hottest trades turn offensive. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. and the S&P 500 losses deepening into the close. The index now at a session low or thereabout, down by about 0.6%. It's chips coming under pressure once again. You can see the Philadelphia Semiconductor Index now off by nearly 5% here. A lot of question marks going on when it comes to that AI trade. Meanwhile, you take a look at the bond market. You're not going to find a hedge there today. A little bit of a sell-off underway. The 10-year Treasury yield higher by 2 basis points. And then Brent, of course, keeping an eye on Brent. Still trading at elevated levels relative to the prior few weeks, but you can see falling a little bit today, down 0.8%, Romaine.
Absolutely. A big defensive posture to the trade as we head into the close. And actually a big embrace right now of consumer staples as a sector. They're actually heading for their best two-day run in more than a month. Meanwhile, the stocks, which Katie just showed, that's now erased all of its gains from the past 2 months, if you can believe it. TSMC's sales outlook was good, at least for TSMC, but when most of its customers are burning through cash at an increasing pace with still scant ROI, well, it's no wonder some investors are rotating just a bit out of that AI trade.
I think you want to be really thoughtful about the positioning that you have in terms of companies that look durable for the longer term in case we do hit any air pockets with the AI trade versus companies that are utterly dependent on everything in AI working perfectly, which is what a lot of them are priced for right now, is absolutely no bumps in the road.
Well, for now, that rotation is benefiting financials and healthcare stocks, which frankly benefited themselves. Strong earnings from the big banks the last couple of days. Some pleasant surprises today from Abbott Labs and United Health, with each raising their outlooks. In fact, United Health up 60% since the end of March, the second best performing non-tech stock in the S&P over that stretch. Now the camera is going to pan to Netflix, one of the worst performing stocks over that stretch, now approaching its biggest drawdown from a peak since that 2022 fallout over the streaming service's unexpected drop in subscribers, a first drop that we saw in a decade. This time around, no subscriber metrics that the company is willing to disclose, but there will be a focus on what's revealed about plateauing engagement trends, a potential contraction in margins, and if and why Netflix would be seeking an acquisition.
The why will be really interesting to get into. An acquisition was seen as a nice to have for Netflix. Now maybe the street thinking maybe it's a need to have. But let's talk a little bit about how the stock has performed. Take a look at the valuation behind me. The last time Netflix shares hit a record high was last June of 2025. That's the last time that this chart had a little bit of green on it. But you can see it has just been a downward climb since then. When it comes to its valuation, it's fallen by about 42% from that peak last June. And you can see we're hitting right now about historical lows or so. We know that, it had a pretty big drop after its most recent earnings report. It'll be interesting to see if they can deliver something that maybe puts a little bit of life back into this chart, Romaine.
The expectations, at least based on Bloomberg estimates, about 14% revenue growth, 10% when it comes to EBITDA, and of course a lot of questions about actually what's taking place within those numbers. Alicia Reese, she joins us right now to kick us off to the close, Senior Vice President of Equity Research over at Wedbush Securities. And I know, Alicia, you've been relatively constructive on Netflix. You still have a buy rating and a pretty healthy price target here. When that report comes out later this afternoon, what's the first thing that you're going to try to look for?
Yeah, usually along with a report, they put out their data file on engagement. I think a lot of people are going to be paying a little bit more attention to that than the earnings. I think the expectation on earnings is relatively in line. The guide is very important, of course, to see those margins and see how the advertising tier is impacting, overall results. But the engagement, seeing how, that's plateauing. And look, a lot of people have been talking about this recently, and the stock has sold off quite a bit on it. But it's not new. This has been happening for some time. Netflix has had to increase the amount of spend on its shows just to keep its engagement roughly in line, and the engagement per user has gone down over time. Of course, some of that was due to adding more crackdown on the ad tier. But you have a significant amount of advertising revenue that's coming elsewhere.
Right.
That's not really, Netflix is not really getting a lot of attention for that at this point.
Well, talk a little bit about that, because I know in some of the past research notes you've talked about the advertising bump, or advertising benefit, I should say. I guess, do you think they're going to be a little bit more articulate about how that is aiding the business, if indeed it is? And more importantly, how far do you think they can go with that? Because at least, if you believe the masses, the unwashed masses on the internet, some folks have bristled with some of their advertising strategies, particularly around that MLB All-Star game.
Yeah, they're being really careful, I think, on the large part. You have to really take into consideration that people are using a lot more YouTube and some social media, doing shorts and stuff. And so they're looking for less expensive content that they can, kind of put against that and keep people engaged. And they have to have a wide variety of content. For the ad tier, you're right. They are advertising on across all of the tiers, including the premium tier, when they have the live sports content like the MLB home run derby, and that's a really profitable situation for them. And to counter that, they have the industry low ad load, and they have a lot of room to increase that on the ad tier. And they don't typically advertise much on their their big huge shows. They use that for kind of serial content that people are a little more used to watching advertising on, and that strategy should work a lot better than it is now over time. So this is kind of a longer term story. I think we're going to see. The real debate is it's not the print that's going to kind of resolve that engagement, but the ad and margin trajectory is going to keep chipping away at the bear case, I think.
Well, let's talk a little bit about the bear case, because I hear what you're saying, that when it comes to the advertising ramp, that outweighs the engagement debate in your view. But that bear case has been getting louder when it comes to U.S. engagement in particular. And certainly you can see that reflected in the stock and how shares have performed over the last year or so. I mean, I know that you have an outperform rating, but at what point would it start to give you pause, that engagement issue?
Yeah, so the engagement has been becoming a concern over time, but not so much as that would impact results and that it would impact expanding revenue. So you have, Netflix has several levers in terms of being able to get the most out of that engagement on the ad tier. They can increase the ad load. They've had historically low ad load across the industry, so they have a lot of room to expand that and earn a lot more on that. Their targeting has been, fair at best, and that's getting significantly better over time, and advertisers are not peeling off. There's a lot of demand for Netflix advertising spots still. So even when you have CPMs kind of pulling out, you have also, the sports, the sports spots and other advertising spots that are, gaining in CPMs, and Netflix has increasingly more of those. So having more productive engagement hours is becoming more of the story here. Now, what would concern us is if engagement seriously fell off a cliff, and we would see that in the data. If we don't see that, then I think that does chip away at that bear case.
Well, I'd also love to get your thoughts on something you also articulate in your notes, and that's this idea of the second season slump that Netflix keeps falling victim to, or seemingly does. You make the point that they tend to market their second seasons less aggressively than they do their first. When thinking about this engagement issue that Netflix is encountering, I mean, why don't they pull that lever? Why not put more muscle behind the second seasons of their popular shows?
I think in the past they just haven't thought that they had to. And because this is becoming more of a focal point for investors, they'll probably listen, and they'll probably do more work around that, because it's an easy lever to pull, and they certainly have that at their disposal, and I think they will. What they also are doing is advertising or marketing a lot of their alternative content, like games or podcasts, and now they're going to have some lifestyle channels, and they might have some more live TV on here soon. So they're going to have so many different things that people can use that will use up their time on the service, and I think that will be really the final what will give the final say.
Alicia, always a pleasure. Alicia Reese, Senior Vice
Thanks so
President of Equity Research over at Wedbush Securities, as we count you down to those earnings from Netflix. Expectations for 14% revenue growth in the quarter to about $12.6 billion, 10% growth when it comes to GAAP earnings. We're going to have full coverage as soon as we get to those bells tonight. We're going to hear from Ross Gerber, a big holder and a big bull on Netflix. We're also going to hear from former Netflix CMO Bozoma St. John, as well as television producer Evan Shapiro, who formerly the president of IFC and Sundance. All of that and more coming up in just a bit, right here on The Close, right here on Bloomberg.
Well, AI jitters putting a chip on the market's shoulder today as semi-stocks sell off in a big way. And our next guest says that the AI investment opportunity, it doesn't lie in a single layer, but across infrastructure, software, and physical tech, and that costs remain a key consideration. Joining us live, I'm pleased to say, is Jitanya Kandari. She is Deputy CIO of the Solutions and Multi-Asset Group over at Morgan Stanley Investment Management. Jitanya, great to see you.
Great to see you guys.
So let's talk a little bit about that, because it feels like AI is basically eating up everything, that it's hard to make an investment that doesn't have some sort of trace back to AI if you map it out there. And I mean, I wonder at this point, do you think it's possible to sort of be able to put AI aside when you're evaluating different opportunities?
Not really. It's like you can't put aside the internet today, right? Like it's there, all encompassing in different sectors. But I'd say, to your point, AI is a cross-asset, cross-sector capital opportunity, right? And the layers are just increasing, right? So you have the infrastructure layer, where you have different supply bottlenecks, and that's shifting. Every few months you see a new bottleneck emerging. You have, the software layer, where who is going to really capture the agent economy? Like the companies that have the data, that have the domain expertise, that have the distribution, and the market's kind of painting that sector with the same negative brush, and I think there are opportunities there. And then who is capturing the physical economy? And again, there is a supply chain that comes with that. And ultimately, industry, who is going to use and harness the AI capabilities to create value, be it a business moat, be it cost efficiency. So I think it's all encompassing. I'd say there are some anti-correlated areas, which is, say, energy or maybe financials, which are more geopolitical and more old economy driven from a market perspective.
Right.
But I'd say that, across different stacks, AI, industrial, healthcare, there's a lot of AI there.
And it's interesting. I mean, as you say, this is an all-encompassing sort of theme, and there's many different entry points into this theme. And I wonder, where you're seeing the biggest opportunity sets, when you do evaluate that different cross-section.
Yeah, so we still do continue to like the memory sector, which is like the real foundation of the token economy that is emerging. Yes, those stocks have run up a lot. There's some consolidation, positioning's really high. But from a fundamental basis, for the next 6 to 8 quarters, we see a lot of visibility in terms of the supply bottlenecks and the demand that's coming with all the CapEx that's out there. I think software is really beaten down, so opportunities there.
I am curious on the CapEx side, but you have confidence because a lot of that CapEx is basically what people are promising to spend. And it seems like every time we get these jitters in the market, it's always about this idea as to whether people might pull back on that or maybe defer it, may not necessarily get rid of it. Is that a worry at all for you?
Not yet, because I said, as you get into, you had the first phase of reactive AI, where you asked a question, you got an answer. You are getting generative AI, which needs 1,000 times more tokens and compute. And then artificial intelligence, which needs 1,000,000 times more compute. So I think the trajectory here is upwards. Monetization is happening. We've seen that in the hyperscaler numbers in the earnings. we're still figuring out on the software side who will capture that agentic workflow transition.
Who do you think might capture that? Is that going to be kind of the bigger incumbents? You know, I've heard a lot of discussion about the idea, okay, why would you count on Microsoft out? Because it's been through so many cycles. But then there are sort of other software companies that haven't necessarily been tested by various shifts in business cycles. Or is that the wrong way to look at it?
I think two things are going on in software. One is we're seeing monetization, right? You're seeing the usage, but I think there is confusion on initial adoption versus efficient adoption, because the tokens are costing a lot as well. So the market's kind of trying to understand what is it that the revenue proposition of the software companies. And two is, earlier you could charge per user in an enterprise, and now one user will have 10 agents. So what does that revenue model look for these software companies is the next question. But I do think in cybersecurity, in industrial software, in healthcare software, there are some good companies that have the data domain distribution and can ultimately be the winners. So market's actually punishing them, and it's a good time to be looking at some of those.
All right, Jitanya, I have to leave it there. Jitanya Kandari, Deputy CIO of the Solutions and Multi-Asset Group at Morgan Stanley Investment Management. And we are going to talk a little bit more about AI, that report we got earlier overnight out of TSMC, and exactly why there are still some fears out there. That conversation coming up after the break, right here on Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. Cinemark gets up first. Wells Fargo downgrading the movie theater chain to equal weight for the first time in almost 3 years, taking a look at Hollywood's slate of films coming up and saying it's not going to be enough to lift the box office for Cinemark in the third quarter. Those shares down on the day. Next up, Lululemon, Truist, the third sell-side analyst team in about a month to slap a sell rating on the athleisure company, citing limited visibility into a potential recovery. Nevertheless, the shares up for a second day. And finally, Etsy, BTIG, going down to neutral, citing a more balanced risk-reward profile after a more than 50% run-up in the stock this year. The analyst removing his price target, saying the stock of late trading less on fundamentals and more on short covering and a rotation out of AI stocks. Those are some of our top calls, and let's talk about that rotation in AI stocks, because some jitters out there after we heard from ASML and TSMC over the last 48 hours. The results were good, the outlook even better. So what's ailing the sector? Stacey Raskin joins us right now to talk a little bit more about this, Managing Director and Senior Analyst of U.S. Semiconductors over at Bernstein. What's going on, Stacey? Is this just the idea we've had a huge run-up in these stocks, high expectations, so we're just bound to be disappointed?
Well, I think that's part of it. You got to remember, it wasn't that long ago that the SOX index, the sector was up 100% year to date, and I don't know, 140 or 150% year over year. It's now up only 67% year to date, and it's kind of where it was trading, a month and a half, 2 months ago. So I do think that things did run up tremendously in front of all those, and now we're starting to see it come through. Again, you mentioned results from TSMC and ASML. I mean, the results were very, very solid. They're so strong, maybe it's getting harder and harder to show even more upside from where expectations were. And
yeah,
I'm not exactly surprised to see this kind of behavior, just given how far things ran. But
yeah,
in some sense, you could argue it's healthy. I would say if we'd gotten to this point like a little more directly through the year rather than like up and down, people would probably feel fine with it.
Yeah.
But just given the magnitude of the run that we did see, especially over the last month or two, in front of this, I'm not entirely surprised to see this.
Well, let's separate the short term from the long term. I mean, I'm looking at SanDisk now, headed for what could be its worst week going back to April of last year. But long term, nobody seems to be counting out the AI trade. But they are sort of making it clear, as our last guest did from Morgan Stanley Asset Management, the idea that there is sort of a broadening out into other pockets. So whether it's the focus, relentless focus we had on GPUs, now the idea a lot of people more focus on the benefits of those folks who are making and selling those CPUs. Where do you see that long-term trade most to the upside?
So actually, we've had this sort of rolling trade over the last 6 to 12 months. People have been playing the bottlenecks. And the bottlenecks are the ones that are sort of rolling over, right? But it started with the GPUs a year ago, right? And then it went to memory, and then it went to semi-cap, and then it went to optical and networking and power semis and CPUs. and then even into the discretes and everything more recently, is AI has gotten so big that it's sort of just dragging everything along with it, and one at a time, these bottlenecks have kind of been hit, and they've been going. And it's funny because like one of the biggest questions I've been getting is, NVIDIA and Broadcom, the guys that sell the compute and sort of the foundation of all this, they've actually kind of lagged.
Yeah.
And I've gotten the question a lot, like what's going to get those working as investors have been playing the bottlenecks instead. And you look in this kind of environment when things are rolling over, like at least on a relative basis, those ones that they've actually relatively outperformed during this downturn. We've got semi caps and some of the memory stocks, everything that are down like considerably off the peak. Go look at where NVIDIA is trading. Like it's down a little, but it's not down nearly as much off the peak versus some of these other ones that were more high flying.
And Stacey, I do want to get your perspective on what's happening outside the U.S. specifically. You think about Taiwan, you think about South Korea more prominently there. Do you think that some of the volatility that we're seeing there has any bearing on what's happening in the U.S. chip industry, or is it idiosyncratic at this point?
Well, I mean, you got to separate the industry from the stocks, right? So the you mentioned Korea, that's been volatile. You have to remember, you got two stocks, your Samsung and Hynix, that basically make up 60%, give or take, of the Korean market. You've had a lot of retail investors there as well who have been levered up. They've been borrowing money to invest in these stocks, and so it drives a lot of volatility and also causes a lot of pain when things roll over. So I do think that that's had some sort of an impact on things. If nothing else, it's just driven volatility higher. You've just had a tremendous amount of concentration in some of those other markets. You don't quite have that in the U.S., fortunately. But these kind of general trends, I mean, I'm looking at my chart here day to day, and all the stocks, I mean, we're moving, 5, 6, 7%, even more in a day right now, and it's starting to feel normal.
Right.
Which worries me a little bit.
Yeah, certainly. Yeah, those enormous swings, perhaps just becoming, normalized, as you say. Stacey, unfortunately, we have to leave it there. Hope to have more time with you again soon. That is Stacey Raskin. He is Managing Director and Senior Analyst of U.S. Semiconductors and Semiconductor Capital Equipment over at Bernstein. Now, coming up, one of the world's largest privately held real estate investors and managers says that there's still opportunity despite supply struggles. David Steinbach, he is Global Chief Investment Officer and a Managing Partner over at Hines. He joins us next. This is The Close on Bloomberg.
3:30 p.m. in a hazy New York City. This is the countdown to the close. I'm Romaine Bostic.
And I'm Katie Greifeld, and we're keeping an eye on equities. But let's talk a little bit about real estate, because the world needs more than it can build. That is the latest message out of Hines. It's one of the world's largest privately held real estate investors and managers. The company's mid-year outlook shows a softer leasing environment in U.S. apartment, industrial, and retail real estate, but says that selective opportunities remain despite supply constraints. Joining us live in studio, I'm pleased to say, is David Steinbach. He is Global CIO and a Managing Partner over at Hines. David, great to see you.
Nice to be here. Thanks.
So square that circle for me, because, we've been talking about supply constraints across the real estate landscape on this show, for months now at this point. You would think that, when you have that constrained supply, that it would lead to a broad rebound when it comes to leasing. But you're saying that's not necessarily the case here.
Yeah, there's real interesting dynamics happening right now in the market. I believe we're in an era of some supply shocks, and we've already seen that the last few years in different ways. I think that's going to continue the next few years. And there's a lot of reasons for that, right? Different nations are trying to build their own national resiliency in different sectors, and that's alone creating some scarcity of product across the domains. Mm-hmm. Also, what's happening is there is a development spread that's not there, and investors are looking for a premium to justify new development. And so while the market needs new development, the spread isn't there to justify it, which means that's not happening. And that's a problem that's going to compound, and it's going to drive rent growth near term, which means it's a good time to be a buyer of real estate, and then longer term, it's going to be draft into more of a development opportunity as the cycle matures.
So a question of timelines here. Well, talk to us about where you're finding those selective opportunities when you take a look at the opportunity set as it exists right now.
Well, certainly, look across the world, and Hines is active in about 30 countries around the world, in Europe, Asia, the United States, and into the Americas. And we're seeing different domains of demand certainly pick up. I mean, certainly, as we've been talking about today, AI is built on real assets, and real assets are going to be needed to support this surge in spending that will continue despite what might be happening on Wall Street with different the different AI chip makers. There's still such pent-up demand there that will continue. Certainly, we're seeing other sectors are continuing to drive interest. Logistics, there's still a lot of demand. Retail is a sector that we've been tracking for a while and been making some very selective buys, but that continues to be interesting globally. Certainly, living has been a category that investors continue to be very interested in. It's first in, first out of a cycle. And finally, office is something where investors were more focused on credit. That's beginning to draft into equity now. Yeah. So we're starting to see equity opportunities there.
But with regards to leasing trends, or I guess more importantly, rent collection trends in terms of what you can get for an investor, from an investor's perspective, which one of those areas is providing a little bit more of an attractive opportunity than the others?
Well, I think some of the dynamic goes back into supply because where we're active in is some of the best space available, and we have not had any issues with collections on our side, and certainly that's something that we're seeing pretty durable through the market. But again, some of that has to do with where we play in the different sectors, and so we're in the highest quality. So we've not really had a lot of issues there. It's really been more about a dearth of supply, and the fact that even if you get that space back, you're able to relet it at rents that feel good.
I am curious about that, particularly on the AI side. There has been some talk about, particularly with data centers, that a lot of the way that they're being built almost as single use. That the idea that if for some reason that data center isn't needed, or the capacity or the demand, it doesn't necessarily match up to the capacity, that there really is nothing else you can do with it, at least that would be cost effective. Is that true, or is that just a mischaracterization?
I think that the data center sector, I think, is still early innings on a lot of evolution that's going to be happening. I mean, a lot of people have analogized it to the electrification of the economy, right? As the electricity kind of came into the system, it not only drove productivity, but also changed in the way it was delivered. And I think that we will begin to see intelligence to be more of something that's bought, on a almost per kilowatt basis, and so that will evolve how different users are buying it. So that all of that's ahead of us. I think this curve is quite deep and long. And so I think when you're making decisions in the here and now, there's still a lot of room for future growth to build into what might be obsolescence in the near term.
Well, when it comes to AI and the build out that we're seeing, the point has been made that there's a comparison to be made to the fiber build out of decades past, and the concern is out there that we could be witnessing what will prove to be a massive overbuild. And I wonder, what your thoughts broadly on that are.
I disagree. I think that, as we've seen in so many other sectors, when things come into the economy that are these productivity boosters, it just drives more consumption of that thing. And so I think that while there might be some fits and starts, just in the micro, you can't ignore the macro. And real assets, the thing that is supporting this, is a long-dated business. And these are bets that are 5, 10, 15 years in nature in terms of what you're building. And I think that the use case there is so deep and long. I'm not worried about it personally.
But I mean, and not to keep harping on this though, but when you talk about sort of the long-term nature of what you do and what your peers do, I mean, I would think that makes forecasting, for lack of a better phrase, a lot harder, because I mean, it's easy to look around the corner and maybe say, okay, where's the economy going to be in a year? Where's it going to be in 5 years? Where's it going to be in 10 years? How do you insulate yourself from, I guess, the unknowns?
Well, I think that is part of investing in real assets more broadly. And I think that you get into supply demand constraints, you get into how difficult it is to build. I think even in things like data centers, we're seeing it's getting more and more difficult to build. Not only is it power, which is what we've been talking about for years, but now it's increasingly communities, and so those are increasing restraints.
Are you worried about that? I mean, we just had, I think our governor here just said she was going to do a moratorium on data centers in New York State.
These things are normal in my world, and certainly Hines' organization, this is what we do. We navigate these complexities because anytime you want to build anything in any major city around the world, there's normal
there's always
difficulties in doing it. Right, there's always
but doesn't
NIMBYism.
this feel a little bit different? I mean, this isn't, there's so much backlash to this, whether it's justified or not. That's a whole other conversation. And we're in an election year, so you have a lot of politicians that are going to want to, tip their hat to it. And it's not just New York. It's not just, sort of one side or the other on the aisle here. It's kind of across the board.
I think it's new for this sector. It's not new for the industry. Okay. And so I think that's what the market's digesting a little bit. It is new for the sector, and they're not used to that. They're used to building these data centers out in far-flung places, and this is something I think will continue.
All right, David, great to have you here. David Steinbeck, Global CIO and Managing Partner over at Hines, as we count you down to the closing bells here on this Thursday afternoon. When we come back, we're going to take a look at shares of Eli Lilly, getting psychedelic. It's our stock of the hour, and it's up next, right here on The Close, right here on Bloomberg. Welcome back to The Close as we count you down to the closing bells. The NASDAQ 100 near session lows dragged down by a lot of those big chip names, and a big dip lower today in Alphabet, down more than 4%. One of the bright spots out there, though, is the pharmaceutical sector as a group, up for a second straight day. And that includes a modest bump on the day by Eli Lilly, up about 1%. This after the company agreed to buy psychedelic drug maker AtaiBeckley. Bloomberg had reported that a deal was in the works. We got the confirmation. No need to pat ourselves on the back. Bloomberg TV markets correspondent Norma Melinda joins us right now to talk a little bit more about this move. I thought weight loss drugs were all the rage. So we've moved on to psychedelics?
We're moving on. It seems as though that's the case. Well, I mean, of course, we do know that the obesity space has been where a lot of investors tend to think about Eli Lilly. When you think about Eli Lilly, a lot of people attach it to that.
Yeah.
Well, they're also
I was just about to jump on that bandwagon, but I'm a little bit late now.
What made you deterred?
Well, now I'm looking at the psychedelics here.
Explain
this to me,
Time to move on. Yeah. Well, we are seeing that they've already pretty much been interested in neuroscience developments. And when we think about the psychedelic space, of course, we know that this was a space that was on the fringes. People were a little bit nervous about whether or not we should really be delving into this space. Now we're starting to see more research and science that's a bit more compelling, and you're seeing companies like Eli Lilly jumping in on the bandwagon. Mm-hmm. Now, if we take a look at this specific drug that we're talking about, it's called the BPL-003. Now, this essentially, right, easy to roll off the tongue. Well, this is a nasal spray, and it's essentially for a treatment-resistant depression. That's what it's designed for. And if we think about J&J, they already have a drug on the market. It's psychedelic adjacent, and it was slow to kind of pick up, but we're now seeing that it has become a blockbuster drug for the company. And so it really begs the question as to whether or not other companies can hop on the bandwagon and do maybe a next generation version of what J&J is doing there.
Yeah, it's fascinating how psychedelics, I mean, they've become basically more acceptable to the point where you do have these giant pharma companies pursuing these deals. Eli Lilly, also interesting because they've just been very acquisitive when it comes to their pipeline. This is the latest example of that. But it's not just this specific company that they're buying today that is rising today. It's really lifting all boats here. Is the idea that maybe we could see some more of this type of M&A come through?
And that's essentially why you're seeing this rally. It's broad-based. It's not just exclusively looking at Eli Lilly or this company, AtaiBeckley. It's also a lot of the peers, and it's starting to wonder and beg the question as to whether or not this actually validates the idea of the psychedelic drug market more broadly. Bloomberg Intelligence actually ran some data. They essentially got an estimate that the market for psychedelic drugs could reach $7 billion in the next 6 years. So could be a lucrative space, and that's what Eli Lilly and other peers are betting on.
And it is interesting for me, this isn't necessarily a question, but you're not seeing Eli Lilly shares necessarily decline on the day, higher by about 1.3%. I guess $3.8 billion on something like this when your valuation is over $1 trillion is kind of a splash in the bucket.
I think it's the idea, too. I mean, it's like people have been banging the drum on this for a long time. It kind of seems like the same thing we heard a lot when it comes to marijuana and THC, that there were real, true therapeutic uses, not just the recreational uses that we would associate with THC or with psychedelics like LSD and et cetera. And now it finally seems the pharmaceutical companies and I guess the FDA have finally woken up to that.
Yeah, it seems like it. Well, we'll see, because we know that when it comes to marijuana, certainly sort of investing along that theme has broken a lot of hearts and wallets over the years.
Are you big into that?
Marijuana? You and I can talk after 5 p.m. Norma Melinda.
That's when we do it.
Great context as always. That is our Bloomberg TV markets correspondent, Norma Melinda. Meanwhile, of course, we are counting down to those closing bells here. Kind of a ugly day on Wall Street, especially when you think about what's going on in Chipland.
Yeah, and in fact, as you speak, NASDAQ hitting fresh session lows here. But it's not really a broad base. You got about half the stocks in the NASDAQ 100 up, but you just have a big drag right now from some of those chip names.
Well, we're going to break down all of the action coming up next with Vinu Krishna, head of U.S. equity strategy and global equity linked strategies over at Barclays. This is The Close on Bloomberg.
Welcome back to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld. About 10 minutes to go until we get to the close here. But we're trading pretty much at session lows when it comes to the S&P 500, when it comes to the NASDAQ 100 as well. It's been a tough day for that chips trade once again, and you can see it right there with the Philadelphia Semiconductor Index down about 5%. We know that Micron, Nvidia, Broadcom, the list goes on, certainly trading heavy today.
And I just want to bring attention to our viewers. Amazon just took a big leg down, a couple of percentage points here. No real news, but something to keep an eye on here as we continue to see volatility in a lot of these tech names, whether they're tied to the AI trade or not, as we await, of course, those Netflix earnings after the bell tonight. Vinu Krishna joins us now to count us down to the closing bells, head of U.S. equity strategy and global equity linked strategies over at Barclays. I mean, I do want to talk about just expectations for the year. You kind of have a market that's kind of, I would pull back just a bit, maybe say trading water, at least when we talk about some of the aggregate headline indices here. But when you kind of break down by sector and even stock by stock, it's like just a multitude of different stories out there. Where are you looking right now?
So I think from a price target, we have 7,800. It means modest upside. I think the difference between when we were a lot more bullish, call it at the peak of the crisis, the Middle East crisis, to now is that the macro environment has become less stable and less friendly. And that is reflected in the fact that you have a new Fed chair and interest rate expectations have changed. Inflation has been sticky. The recent print has been good, but the jury is still out there whether or not we actually see inflation coming down. And of course, not surprisingly, the pickup in Middle East crisis once again leads to a lot of uncertainty around oil. So all that means that this is coming on top of, at the fundamental level, that the market was already reassessing the whole AI narrative. And so when you combine the two, our view is that earnings are going to be really strong. We have visibility through the end of next year, or at least confidence. But you want to be cautious in what multiples you pay, especially given the rate risk. The 10-year is now past 4.5 in danger territory already.
Well, I am curious about that. I mean, and we just put out, Bloomberg actually just put out its compilation of Wall Street targets for the S&P for the year. You raised your target, as you noted. Overall, the average went up by about 100 points for the S&P. But I'm more intrigued by how the targets have gone up for the earnings. And obviously, I assume that's why the actual price target went up as well. But we've come a long way because we go back to the beginning of this year. People were a little bit more muted in terms of their expectations for earnings growth. And now everyone seems to be pretty bullish about S&P EPS holding up through the end of the year despite some of the issues that you just raised.
Yeah, so I think because that is again linked to the AI narrative, and interestingly, while the narrative has shifted somewhat, especially for the hyperscalers, the reality is that level of spending, which continues to go up and has gone up even further after the Q1 earnings, let's see what we hear in Q2 earnings, is supporting a very broad-based set of the rest of the S&P. In other words, outside of hyperscalers, rest of technology, components, chips, storage, and then going to power and utilities, parts of industrials. So, that is where the earnings strength is coming from. And the visibility is there because if you know they're going to spend trillions of dollars in the next 3 years, those trillions are going somewhere. And all the receivers of the trillions, that was the trade, right, recently, which is cut your exposure to the hyperscalers who keep spending, who are posting great earnings, but there's uncertainty as to the timeline of spending, when will we have line of sight on when it starts tapering, what's the real return on that, and all that uncertainty. Meanwhile, the guys who are receiving the dollars, there's visibility because people who are spending have the capacity and the ability to spend.
Well, it's a little bit funny, right? You think about, the free cash flow drawdown when it comes to a lot of those hyperscalers, when it comes to the Magnificent Seven, kind of funding the earnings strength of the rest of the market. Do you think that we'll start to see any signs that it's directly benefiting the companies that are actually spending all that money, though?
it is already benefiting them, right? Because AI adoption
But you're not seeing it necessarily in the stock performance.
Exactly. And the reason is simple. They posted 30% earnings growth in Q1. The expectation right now is 31% for big tech as a group, which includes most of the hyperscalers. The expectations for their margins is also higher compared to even a year before. What has changed is, given the scale and the continuation of the spending, the market is a lot more cautious on the multiple they're paying. So we started the year at big tech multiples at 28 times forward earnings. Right now we're between 23 and 24. And actually, I like that combination. The fact that multiples are derating to reflect the risk of continued spend. So we don't know whether this is a permanently capital-intensive business till such time that we know where the AI narrative settles. And that takes another probably at least 2 or 3 years in adoption and improvement in productivity and impact on margins and such. So till such time, these companies, by the way, are posting excellent earnings. And we do expect them to post excellent earnings. The only question, to your point, is that free cash flow is going to come down. In fact, we expect in the next 3 years, each year, starting this year, that they will be spending well over 90% of their operating cash flows. And that's the reason why they're also beginning to tap the equity markets, the convertible bond market, credit markets to raise more capital, where initially there was excitement, and now there's again some short-term digestion issues.
Yeah, you certainly see that when it comes to these primary credit markets. We have just over a minute left with you or so, and I do want to take a hard pivot here, because in the commercial break, you told us it was time to start paying attention to the midterm elections. Tell us why.
Yeah, because historically, if you look at the midterm elections, equity markets do underperform compared to non-election years. That's it. But I think if you dig in deeper, what we found, at least empirically, over the last election cycles, is that the worst months are August and September. So not only do we have higher macro risk, but we also have the midterm risk, which is important. But the key takeaway is, once you come out of the midterm elections, equity markets rally. So the year 3 of a presidential election, the markets rally, and that is intimately connected to the fact that policy risk tends to be lowest in year 3, right? And so I think that's what you can expect, and especially if you see a decline in tariff risk, which is already down, and national security risk, for example, then the sector which benefits the most is technology. So interestingly, the sector at the maelstrom of this current sort of uncertainty is likely to be the biggest beneficiary coming out of the midterm elections.
All right, so maybe technology saves us once again, as it continues to do time after time. Vinu, great to have you here. Vinu Krishna, head of U.S. equity strategy and global equity link strategies over at Barclays. As we count you down to the closing bells, off the session lows for the major indices, but of course, everybody right now keeping an eye on Netflix.
Just a few more minutes to wait, and of course a lot of eyeballs on Netflix, because you think about, how the stock has performed. It's down about 45% since its all-time high, which was reached back in June of 2025. Really one of the worst performers over the past 12 months. We'll see if they can right the ship, but they have a little bit of a tortured history when it comes to earnings reactions.
It will be an interesting earnings day, and the real story will be what's in between the lines of those numbers. Our coverage of those earnings starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar, Tim Stenovic, they join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube, an eye on the broader markets, and an eye, Carol Massar, on Netflix, which reports earnings in just a matter of minutes.
Yeah, absolutely. We are definitely focused on it. Keep in mind, the stock's down 22% year to date. It's off more than 30% since hitting a high in 416. Why is that important? That's the last time it reported earnings, and there was some disappointment in terms of its profit outlook. So we're definitely homing in on that one. But I think it's interesting that here in the last few minutes of trading, you see some buyers coming in, pushing those major averages off their lows of the session.
I'm always keeping an eye on oil prices, as you guys know, especially of late as we've seen things flare up in Iran and in the Strait of Hormuz as the U.S. continues its barrage on Iran. Katie, today, oil prices not changed significantly, actually. Brent at 84.30. WTI 79 a barrel.
Yeah, pretty quiet overall when it comes to the cross-asset picture. You saw a little bump up in yields. It really felt like it was all about chips today. I know that Carol, it's optimistic to say, you know, we pushed off those session lows, but overall, it was a pretty ugly day, and a lot of that, once again, traced back to those chips.
We are seeing some pretty significant drops in names like NVIDIA, SanDisk down more than 10% on the day, Alphabet down by about 4.5%. And just a few minutes ago, we saw a big spike down in shares of Amazon, though no real news as to exactly why. Red across the screen for most of the major indices, with the Dow going to finish the day lower by about 0.2%. The S&P lower by about 0.5%. The NASDAQ Composite and NASDAQ 100 each down roughly about 1.5% or so. And the Russell 2000, that's going to finish the day flat on the day, but in the red.
And I'm just going to point out, you've got more names in the S&P. The majority are actually higher today, despite the overall index lower, Katie.
Yeah, it's the same story when you take a look at the sector level as well, really showing that you can have this broadening out beyond tech, and you might not necessarily see it at the benchmark level because you have information technology down by about 1.8% as a sector. That is weighing down the rest of the index. In terms of what did gain today, you had healthcare as a sector higher by about 2.2%. Consumer staples was your big winner on the day, 2.9% higher. But again, that's not going to be able to offset that big drag that you saw from tech and from also communication services.
For so much of the day, we saw that the stocks, everything, all 30 components of the stocks were lower. Skyworks Solutions and Qorvo, though, eked out ever so slight gains. 28 of the 30 names in the stocks fell. Broadcom, Micron, Marvell, and NVIDIA leading the pack lower.
Netflix share earnings crossing the wire right now. We'll start with the most recent quarter, second quarter revenue, a modest miss, $12.56 billion. The street was looking for $12.58 on average. It looks like for free cash flow for the most recent quarter, $1.53 billion. That's a big miss. The street was looking for $2.72 billion. EPS in the quarter, a beat by 1 penny at 80 cents. Here's your forecast for the current quarter. The company sees EPS of 82 cents a share. The estimate on the street was for 84 cents a share. With regards to revenue for the current quarter that we're in, the third quarter, $12.86 billion. The street was looking for $13 billion. Similar story with some of the other numbers here, guys, as we start to parse them. But it looks like a miss for the second quarter and a slight guide lower for the third.
All right. So what's interesting is there was a miss last time around, and we did see the stock sell off. Lucas Shaw out with a story already on the Bloomberg, reminding everyone what Romain said. Netflix forecasting a second consecutive quarter of slowing sales growth. Projected revenue of $12.9 billion, earnings of 82 cents a share. He points out the shares have declined more than 40% over the last year due to concerns about its future, despite still having more subscribers and viewership than any other paid streaming service. He reminds us, too, Lucas Shaw of Bloomberg, Netflix that is, investing in new kinds of program, live sports, video podcasts, and is leveraging generative AI to deliver higher quality output more quickly and at a lower cost. But I got to say, well, investors may be buying some of this because right now the stock is up about 1.6%. But again, it's been pulling back since it reported earnings back in April.
Yeah, just looking at the investor letter, it kind of repeats a lot of what Carol said, but some additional details about those video podcast creators like Danny Go and Salish and Jordan Matter, cloud TV games too. The company said, and Carol mentioned the idea of leveraging AI, but remember they did make that big acquisition of Ben Affleck's company. Now the company says it's leveraging AI to provide a more personalized, immersive, and interactive experience for members. Also to make those ads more relevant for people who don't pay for the service without ads. Also improve the quality of the series and films. They call the entertainment industry dynamic and competitive, and they're staying ahead by executing against delivering value, leveraging tech, and improving monetization.
Yeah, and when it comes to monetization, let's talk a little bit about the ads business. That coming up in the statement as well. The company says building out our ads business continues to be a top priority, and we remain on track to deliver approximately $3 billion in ads revenue in 2026. And we were having this conversation with Alicia Reese over at Wedbush earlier in the show. There's been a lot of concerns around engagement. Of course, Wedbush's view is that basically this ads ramp up outweighs that debate, but we know that that is top of mind for investors and certainly has weighed on the stock.
And I'm just taking a look at their release, of course, the what we watched for in the first half of 2026. We should point out that this semi-annual report they're now saying is going to be annual, which is kind of interesting because the idea here, they continue to give us less visibility into some of these things, pulling the subscriber numbers and now going to an annual basis on that. As far as for the semi-annual report that came out, the company says that audiences watched more than 97 billion hours of Netflix in the first half, their highest view hours to date for any half. And, well, you can pretty much guess what some of the biggest, most watched names were on that. The Night Agent, Lincoln Lawyer, Bridgerton, of course, leading some of those names.
Bridgerton. Hey, let's talk about revenues and where they saw growth around the world. U.S. and Canada revenue was up 10% year over year. That estimate, though, did come in a little light. When we talk about Europe, Middle East, and Africa, that was up 14% year over year. That was spot on at about $4.03 billion. Latin American revenue was up 21% year over year, a little bit higher than the street forecast. And APAC revenue, that growth was up 16% year over year, and that too came in a little bit light. So it looks like around the world, maybe not hitting those numbers when it comes to revenues.
So, Romaine, you mentioned the change in disclosures. The company saying it's in the letter, quote, evolving our view hours disclosure. So the change, they're going to report these industry-leading title by title and total view hours data, including weekly top 10 lists in more than 90 countries, separating the publication report from our earnings results to keep the focus on our primary financial metrics, which they argue is revenue and operating profit. I think a few years ago, if we would have said what are the primary metrics, it would have been total number of users. They don't report that anymore.
They don't report that, but the financials are holding up. They also said last quarter that they wanted a much more of a focus on cash flow, and those cash flow numbers, at least based on what Bloomberg's reporting, missed pretty big. And so it raises a lot of questions that as you pull back visibility from what people are watching or how they're watching it, and now you're saying, okay, well, the financial numbers are what we should be pointing to. What am I looking at here that's positive?
I do think it is interesting that it seems like less disclosure is sort of the trajectory that Netflix has been going down. That decision to stop breaking out subscriber numbers now when it comes to the What We Watched report, going to be annually versus twice a year. I can see where the company is coming from, focus on the numbers themselves. But to Romaine's point, if those start to dip as well, then, you're seeing that after hours right now.
Well, all you have to do is put it into an AI model and you can come out with the number. So it's not like it takes a lot of work anymore.
Anyway, but when we talk about some of the reporting that Lucas had done about, the idea of engagement and this being an issue, and that feeds into the numbers. And we've talked with a lot of analysts that are a little bit concerned about not having that visibility and being able to track this. Maybe the ad business does become more of a dominant business, but how do you assess that and you have a sense of, what people are actually watching, why they're watching, how they're engaging? There's also a big question about how they're going to pay for content, push it into live events that are as costly and in some cases more costly than some of the scripted programming that they have.
Right. We talk about the costs of any kind of sports coverage, right? It's a lot of bidding. It's a lot of expensive. It's very expensive, I should say. So go back to free cash flow, $1.53 billion. Again, I want to go to that number that you are highlighting, down 33% year over year. The estimate was for $2.72 billion.
What was the most watched movie in the first half, Carol Master?
I don't know.
War Machine. Then it was The Rip, then Swap, K-pop Demon Hunters, which is a surprise, was only number 4.
Yeah.
And then when you talk about the actual shows, the non-movies, it's His and Hers. Bridgerton was number 2. Stranger Things was at 4. And then it kind of drops off after that. I
haven't seen one of those titles.
Have you seen Miss Rachel?
No. I don't you have know I know who Miss Rachel is.
Do you not let them entertain themselves?
There's plenty to do.
No screens.
Without,
it's just at Tim household, no TV, no junk food. It's just, sit there and eat your carrots.
You know I'm that type of dad.
He's very careful what goes in those kids. With those kids.
Good for him.
Hey, the one thing I'm curious if it'll come up on the earnings call. Remember, it was in April too that they authorized, I think, an additional $25 billion buyback. So I wonder if they pare back on that. Yeah. So we'll look for some stuff on that. And we know you're watching Bridgerton, Romaine. You can share that with all of us. You're among
I don't know what that is.
Yes, you do.
Is that like Downtown Abbey?
No, much better. All right, we're going to wrap on that. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals.
I love period pieces.
We do call it the closing bell. Romaine and Katie. Good to have Katie back there on The Close on TV. Tim and I back here on Bloomberg Business Week Daily. Folks, we'll see you again tomorrow.
Our coverage continues of Netflix earnings. The share is now under pressure, down about 6%. The numbers are in. There is revenue growth and there is profitability growth, but those numbers missing just ever so slightly. The guidance for the third quarter, the current quarter that we're in, a tad light as well. Geetha Raghunathan is our U.S. media analyst over at Bloomberg Intelligence. And Geetha, you had a note out coming into this report, and I'm just going to quote it directly. You said there was going to be a lot of focus on plateauing engagement, content creation, AI concerns, muted margin guidance, and an M&A overhang. I know we only learned so much from the actual report that they put out, but what did we learn? And are you feeling any better about Netflix now than where you were a few minutes ago?
Not really, Romaine. So, we were kind of looking for some kind of guidance raise, either the revenue numbers or the operating margin. They really didn't do either of that. And then, of course, the all-important number was the third quarter guidance, which, as you pointed out, came in way below consensus. So 11.7% is what they're guiding to. Consensus was expecting just a touch above 13%. So again, not a lot to get excited about, and really kind of feeds into that whole bearish argument about all of the things that you highlighted, especially plateauing engagement.
Well, let's talk about plateauing engagement, because we did hear from the company that the amount of time that people spend on Netflix grew 2% in the first half of 2026. The company highlighting that they had competition from the World Cup, the Winter Olympics, among other things. That 2% figure, how do you feel about that?
Yeah, so we've this is partly because of the law of large numbers and to be expected, I think. But we've been used to seeing in the past, Katie, engagement growth growing in the mid-teens. So when you kind of see this really dramatic slowdown to the low single digits, obviously it does spook investors. Then again, you kind of look at those World Cup numbers, and this is exactly what I think investors were fearing. Like, that is definitely going to have a demonstrable impact on the 3Q guidance, and voila, we did see the 3Q guidance come in a lot lower. So again, and then there's of course that Nielsen report, which points to Netflix engagement or a share of TV viewing time in April, which was the lowest in about 10 to 11 months, and far lower than the 9% that they saw at the end of 2025. We were at about 7.8%.
Yeah.
Meanwhile, you see YouTube consistently growing. So this is where really a lot of the fear is kind of coming in, and today's report really does nothing to assuage that.
Well, that's what I'm curious about too, because Geetha, we talk about their competition with YouTube, and they've articulated that on their conference interview several times. But it's a totally different format. At least generally, the types of videos that you get on YouTube are a lot different than the type of content that you're going to get on Netflix. So it's not necessarily a one-to-one. And do you have any sense here as to whether Sarandos and the other executives would try to push a little bit more into the type of content that you do see on YouTube? Or can they sort of turn things around with, I guess, the more traditional big movies, big series shows that they are used to putting out?
Yeah, absolutely. They are definitely going to put out more of the traditional content, as you pointed out. The shows, the movies, and that is exactly what they were going after with that Warner purchase. But they're also realizing that they have to compete against short form content. And at the end of the day, everybody only has 24 hours, and it's about how much time are you going to be able to spend on the Netflix platform. And so they have to kind of come up with a better strategy for content diversification, and they're doing that. So in the beginning of August, we are going to see them debut some short form content. They're getting content from different publishing sources, BuzzFeed, Condé Nast, People, Variety. So that's really kind of them taking on YouTube in a very small way, but still kind of going after that content. But at the end of the day, again, they are competing against all of these social media platforms. It's not just the big streamers like a Disney or an Amazon Prime Video. So they do have to articulate, better strategic direction, I think.
Yeah, absolutely. And you think about Meta, too. Announcing that it's also exploring new formats. Instagram for TV, that's a platform that Meta is looking at. And we know that Instagram has had success when it comes to Reels. And so, Geetha, when you add it all together, you think about the competition that they're seeing from the short form side. Do you have the confidence that, okay, yes, they need to do something there, but do you have the confidence that they'll actually be able to gain some traction in that space? Because, it's pretty saturated at this point, and it seems like everyone is trying to engineer their own strategy.
I think, in the near term, we're obviously going to see, I think, a lot of noise, a lot of volatility. At the end of the day, they speak a little bit about this in their investor letter about those AI-related savings. And I think it comes down to how they can harness and harvest those savings into more differentiated content. So yes, allocating a little bit of that for short form content, but then really going after the content that is going to help them monetize better, which is advertising. So really kind of getting more into live and sports. They've dipped their toes a little bit, but it's just not been enough, because if you look at their content budget, it's $20 billion this year. They spend about less than 4% of that on sports content. They really need to, I think, really beef that up pretty dramatically. I mean, you look at Disney spends about 40% of its budget on sports rights. So, they absolutely have to do something to move the needle here.
Absolutely. Well, Geetha, great to get your instant reaction there. That is Geetha Ranganathan. She is a U.S. media analyst over at Bloomberg Intelligence. And let's keep the conversation going on those Netflix earnings with Ross Gerber. He is president and CEO of Gerber Kawasaki Wealth and Investment Management. Ross, it's great to have you with us. So heading into these results, you made the point that the market needs some clarity of their direction. Netflix is still the king here, but the market and investors looking for some direction as for what's next. We know that Netflix is towing into live sports. Do you think that they're doing enough?
Well, yes and no. Like, they certainly have made a lot of progress with live sports, with some positive results and some negative results. I don't think that they want to, or it makes sense for them to spend tens of billions of dollars buying sports rights. ESPN's already done that. So I like their approach to sports, because they're trying to measure the cost to the return. But we're kind of getting sort of random sports on Netflix. But we will be getting more NFL games in the future. But I don't see that as sort of the end-all be-all for them, because it costs so much for sports rights.
Well, what do you think that end-all be-all is? I mean, as you say in your notes, still the king here. You do own Netflix in your fund, but what do you think they should be really focusing on at this point, as you have these swirling concerns, especially around engagement and increasing competition?
Well, as you saw with the attempt to buy Warner Brothers and this whole thing of consolidating streamers, like, the streamer business has reached sort of its max, in that we have enough streamers, we have plenty of content, there's lots of competition. So, not to Netflix's fault, but there was a lot of competition this quarter for them for these viewing hours. There was a lot of choices and people will follow the World Cup or the Winter Olympics, or they're going to watch what they're going to watch. And right now HBO has a really good lineup, for example, and that might change. And it kind of goes back and forth. So what's the future for Netflix? And they've really made a commitment to video games and live entertainment. And I think it makes the most sense for them to continue into these two paths. Video games is a wonderful business if they can monetize their IP this way. And then live entertainment is really where they haven't been, which I think is a huge missed opportunity. Getting these movies into theaters, putting these shows in theaters, and generating revenue from the theaters. In my estimation, that Netflix could make billions of dollars a year just in the movie theaters if they threw a few of these movies out there. And nobody cares if they have to wait 2 or 3 weeks to get the movie on the streamer. Yeah. It's not that big of a deal. I think it actually helps build anticipation for those titles on the streamer once it gets out of theaters. So I think that's the next thing. It's live entertainment, it's sports, and it's video games.
But on the theater side, too, I mean, let's get to some leadership questions, too, Ross, or strategy questions, I should say, too. I mean, it seems like they've been a little reticent to embrace that idea. I mean, there was a lot of talk about K-pop theme hunters and how quickly they pulled that from theaters, despite the fact that everybody seemed to want to see it in theaters and be part of that experience. And it seemed like they kind of missed the mark. Sometimes you have to read the room and realize that you have something there, just run with it. Forget, I mean, I don't know what their internal metrics are like when it comes to what do we need to get on the streaming platform first relative to the theaters. But do you have confidence that the management has the ability to pivot when they do sort of tap into something that clearly has grabbed everyone's attention? I mean, we're an attention economy.
Right, and this is why I was buying the stock recently in the low 70s, is because I very much believe Ted Sarandos is sort of the genius of Hollywood right now, and they have the best management around. So I'm sure they get what they need to be doing. It's just a difficult time to make these kind of moves right now. Hollywood has so many cross currents going on. And so Netflix, after just going through this whole battle for Warner Brothers, which I was glad they lost, they have the capital, they can do things, and they're very measured with their strategic focus. So I think that's all good. But when you look at the stock down here, let's say it's $70, you're paying less than 20 times forward for Netflix. Netflix isn't going anywhere. And I have to, reiterate this. We're going to be watching Netflix. Our kids are going to be watching Netflix. So for investors, this is a wonderful opportunity. Whenever there's uncertainty over Netflix's future, they always seem to figure this out. And we value the company substantially higher than the current price today. So any pullback here on earnings, we think is an opportunity because these are very durable, good earnings reports with lots of cash flow. They buy back their stock. They're a very shareholder-friendly company.
Well, and I don't want to dispute that, and I don't mean to be glib, but I mean, we had you on last quarter, and the stock was under pressure, and you were like, don't count this out. The stock will be back. It's 3 months later. It's still down. It's down in the after-hours trading. The buyback, I guess, provided a little bit of a floor, but not much. Going forward, as you value this stock, Ross, and I mean, we had Geeta Raghunathan. I go through her decks, and she's valuing this up against, Warner Brothers and Disney, et cetera. I guess my question is that the right way to value Netflix? Should you be valuing this more? I know it's hard to get visibility into YouTube and some of these other things that are under the umbrella of larger companies like Alphabet, but is that where we need to start looking at the valuation comparisons?
No, I mean, valuations should be relevant to your track record as a company. It's certainly which industry you're in matters. So when you look at a company like Warner Brothers or Disney and you look at revenue and earnings growth, well, there is none. So that, that's a totally different story than Netflix, which has had consistent incredible earnings growth for a very long time. I've owned this stock for a long time. And so you're talking about a company that just, they beat on earnings. Let's be real. It wasn't like a bad earnings report by any means. The fact that they're not blowing it out right now, I get it. And I do think they need to articulate, like, where are they going to really grow? They said they're going to grow their business, substantially over the next 5 years. So what's the strategy? And that's, I think they need to articulate more clear. But from an investment perspective, whether the stock's the same price as it was 3 months ago or not isn't relevant to me. I'm a buyer of these securities, but where the stock will be in 5 years is what's relevant to me. And so I think if you're an investor, this is a great opportunity when there is uncertainty, when people don't believe in Netflix and you're willing to get an under 20 multiple for forward earnings, when people are paying ridiculous multiples for all kinds of stocks. So, we own brand name companies that aren't going away. It's almost like a Warren Buffett pick at this point. At this valuation. He added Google, maybe late. Maybe he's going to look at Netflix now.
Ross, always appreciate it. Ross Gerber with conviction, once again, president and CEO of Gerber Kawasaki Wealth and Investment Management. We keep the conversation going here, particularly about some of the broader cultural trends. And who better to talk about that than Bozoma St. John? She's worked for Uber, Endeavor, and yes, of course, she was previously the CMO over at Netflix. Well, it's great to have you back here on the program. I do want to kind of talk about these cultural moments, and we were just talking about it with Ross, with how K-pop Demon Hunters sort of captured everybody, and some people would argue Netflix kind of dropped the ball in sort of making sure that stuck. When you sort of talk to companies and advise companies about how to be in the zeitgeist, or if they find themselves in the zeitgeist, how to best capitalize on it, what's the advice that you give?
Well, thank you for having me. It's always great to be here. Look, the cultural trends are very, very tough. Look, if somebody had the magic 8-ball, the crystal ball, any kind of predictor on how to capture audience sentiment, they would be the billionaires, right? I think the challenge is always trying to figure out what's happening in culture, how to make sure that you're on top of it. Again, some of the conversation you were having before is a difficult thing to do. We can sit here and pontificate, but it is hard to predict where the culture is going. And then the bigger challenge is to move this mighty ship you have, the big company you have, to chase said trend. And so a lot of times what you're doing is trying to guess where the market is going to go and then meet them where they are. So sometimes you miss the mark because you've just guessed wrong, not because you're bad, just because that the culture has moved a little too fast.
Well, I am curious too, particularly when it comes to streaming. And you left Netflix several years ago, but the streaming landscape has changed a lot. Obviously, the pandemic supercharged thing. Everybody came out with the streaming service. Netflix has been pretty upfront that it doesn't even really see the other streaming services as its competition. It's YouTube, it's video games, and all the other things that compete with attention. As somebody who has a teenager in the household, I can assure you, his attention is everywhere, and I'll just be blunt, it's not on Netflix. And I am curious about where that attention is going right now, and is there a need to be able to harness that under sort of one umbrella, or can it be disparate amongst the various sort of streaming services, et cetera?
Yeah, well, that's a great question. Look, I have a teenager in the house too, so I've got the focus group of one in my house. The truth is that, look, we've known for a long time that audiences are multi-screen. While you are watching your show, whether on a streamer or linear TV, you're also on your phone. You may have a laptop in front of you or your iPad. And so consumers and audiences are doing multiple things at one time. Look, they can be watching a show and realize that they love the fashion, they love the sneakers a person is wearing, and be on their phone searching for that sneaker. They could be, watching a show and then it's about some sort of historical fiction and they want to know the real story. So they're over here searching, Google to find out the real story about that person. There are so many ways in which to get the consumer or the audience. And so I think that it's always best when you have an attention of an audience to make sure that you're also in multiple spaces, maybe even in social media, which is keeping up with programming, to make sure that you are capturing the attention of that audience while they're in the moment of watching your show, or enhancing their experience using other forms, other devices to make sure that they remain in the world that you've created.
Well, it's interesting. I mean, if you've been on TikTok recently, if you're watching a video now, you have a little thing that hovers over whatever someone is wearing that says find similar items. So you're seeing more and more of that integration. But would love your perspective, on how important it is to sort of nail the tone here. Because, even if you have a short-term or a short-form video strategy, the authenticity might fall flat. There's no guarantee that that actually is going to gain traction in a meaningful way.
Yeah, no, you're absolutely right. Look, again, we can't have the complete knowledge or understanding of what any consumer is going to do. The best you can do is try to give them as many options as you can while remaining in your universe. So even if you have something that hovers over the program or hovers over the short-term content and takes them outside of your world, what you're trying to do is make sure that they come back. So is there a way to continue enticing audiences to do that? Because you're right. Look, the audience attention is going to be all over the place. And so to the point that was made before about, Netflix, competing with not just other streamers, but competing with every other piece of entertainment in the world, then yes, you're trying to capture your audience to stay within the world that you're creating.
All right, have to leave it there. Really great to get some time with you. That is Bozoma St. John. She is former Chief Marketing Officer over at Netflix. You take a look at Netflix after hours right now, down about 8%. It's going to be interesting to see if things can turn around when it comes to that call. Maybe we'll get some details about a buyback or something along those lines. But Romaine, at least for right now.
This goes deeper than a buyback, though. We
Yes.
talk about a company, and Ross is right. The numbers themselves, they're not awful. But this idea here that you talk about, what's the growth story, right? Ultimately, you're paying for earnings in the future, not necessarily what we got. And then what you got was decent. But what's the long-term growth story?
Yeah, absolutely. And when does these engagement concerns that investors have articulated, when do those really start to impact that advertising ramp up that has been sort of the rallying cry for those who are still bullish on the stock? We're going to continue to stick with these Netflix results and talk with Wedbush's Michael Pachter, who joins us next after the break. This is The Close on Bloomberg. Shares of Netflix down about 8% after hours. Those results coming after recent data shows that the streamer is struggling to keep viewers around for more than one season. The team at Wedbush noting part of this is structural, saying, quote, the long gap between seasons works against a binge and forget consumption pattern that rewards novelty over continuity. Michael Pachter. He is Managing Director of Equity Research over at Wedbush. He joins us now. Michael Pachter, great to have you with us. So let's talk about that a little bit. The second season slump, this idea that Netflix is having trouble keeping viewers to stick around for the second season, which feeds into those engagement concerns. I wonder, what you make of it. What levers basically Netflix can pull here?
I think Netflix is doing everything they can to provide enough content to keep us engaged. And I think that part of it is, we're drinking from a fire hose as consumers. It's really hard to find things, and the shows have to be really good to bring you back. And I think that the sheer volume, the sheer quantity of what they offer makes it easy to switch. And I'll tell you an anecdote, I frequently find shows that I started watching a year or two or three ago, and I forgot. I just forgot, because I got overwhelmed by other opportunities to see other things. So I'm not as worried about that as I am about the decline in engagement. As you said, my colleagues pointed out, that Wedbush pointed out, that part of this is attributable to the number of viewers per household and the way they crack down on password sharing. So the one metric in this earnings letter that really jumped out at me was we're approaching 1 billion customers. Now, we know the number of subscribers is in the 300 million range, or 330 or 350 or something, but they're approaching 1 billion, which means that there are 3 people per household that are actually viewing the content. And of course, as you start counting more users, the actual number of hours per user engagement is going to drop. That's what we're seeing, and I do not think it is a fatal flaw. I think it's just a consequence of them actually being in, the households of 1 out of 8 people on the planet. That's pretty impressive. And I think you should really pay attention to that metric, because I think that billion is going to grow to 2 in the next decade. So there's plenty of opportunity for these guys to make a lot more money.
Well, one of the concerns out there is that, the rise of sort of short form video, the rise of YouTube is going to derail that path from 1 billion to 2. There was some interesting data out from Nielsen basically showing that in April, Netflix's share of TV viewing time represented 7.8% of all TV viewing. They found that when it comes to YouTube's audience share in April, that rose to 13.4%. So how are you sort of factoring that in when you map out the future trajectory for Netflix?
Well, first of all, I'll say that I think Nielsen is just full of crap. I mean, I think that they have the metrics they have, and they can't extrapolate globally. I will say I don't think Netflix is violating securities laws. So we know that nearly 1 billion people, let's call that 970 million, viewed 97 billion hours in the first 6 months of the year. They just put that number out. We saw it. So that's 100 hours per viewer for 6 months. That's a lot. And if you want to tell me that that's only 6% of total viewing time, I call BS on that. Sorry, the number's just wrong. We don't watch 600 hours of television a month, or whatever it is. It comes out to be some crazy every 6 months. Sorry, we don't watch that much TV. And watching 100 hours of Netflix, I did the math wrong, but 1,600 hours every 6 months. That's just crazy. So I really think, look at the Netflix numbers and you say, wow, these people are super engaged, and they're generating, call it $25 per viewer in spend. So they're spending 25 cents an hour for their content. That is cheap. That's not going away. Nobody looks at that as too expensive for 100 hours of content consumed. So I absolutely think Netflix has the right formula. They are in a position now to leverage their content and start to really drive profit growth. So I agree with Ross Gerber for the first time in about a decade. He's right. These guys have just begun their earnings growth, and it's an earnings growth story, not a stagnant earnings story at all.
I am curious about just the different tiers that they've released, and there's been a lot of speculation as to, as they push deeper into advertising, whether they would actually re-embrace a free tier that is a lot more ad heavy than the rest of the tiers as well. Would that encourage you? Would that sort of create a little bit more optimism for you, or do you not think that's necessary?
Romaine, it's a great question, and I don't know what Netflix is going to do. There is a real trade-off between driving engagement and driving monetization. And if you can make up that $7 or $8 per month that you're charging to the ad-supported tier with more ads, then absolutely. There are customers who aren't going to pay the $8 and who will absolutely watch an ad-supported tier. If you can drive that billion users up to 3 or 4, and the incremental 2 billion are generating 3 or 4 or $5 a month in ad revenue, it's worth it. I can't make that call, but directionally, I think that that's right. So is there an answer where you cut the ad-supported tier price to $5 and increase the ad load to 8 minutes an hour and see what happens? Yeah, and they'll test that. They have test markets where they can test that. I think you're right directionally that that is the solution, but I cannot tell you they're going to do it anytime soon.
With regards to longer-term growth and, more importantly, content, they make no real mention of Warner Brothers Discovery in the press release other than for the termination fee. I'm sure this will come up over the next few days and weeks as analysts get a chance to actually have some FaceTime with Greg Peters and Ted Sarandos here. Was walking away from Warner Brothers the right thing to do? And do you think that Netflix should consider M&A in the future?
Walking away was absolutely the right thing to do. And, you know, there's an old saying, you know, why buy the cow if you get the milk for free? You know, you don't need to pay for this content. You can rent it. And if you actually look at Warner Brothers and Paramount, they have way more content than they can exploit. And so, you know, can Netflix license this stuff? Absolutely. Can they license it first window exclusive? No. So the acquisition was going to give them first window exclusive only, but can they license the content and make a a Green Lantern television show? Sure they can. You know, or a Jimmy Olsen or a Crypto the Dog cartoon series.
Okay,
sure they can.
Okay, yeah, that's an interesting choice, Green Lantern, Michael. Not to be clear.
Pardon?
That's an interesting choice, Green Lantern.
Well, whatever. It's a smaller character. No, you say that, but
I'm just teasing you.
When Guardians of the Galaxy came out, I was shocked. I am notorious for downgrading Marvel right a month before they sold to Disney because I said nobody had heard of Iron Man or Thor, and I defied investors to describe Iron Man's outfit, which of course is gold and red because we all knew that, didn't we? Yeah. Nobody knew. So those were obscure characters at the time, and they worked. Guardians has worked. I think Crypto the Dog would work. So I said Green Lantern because I think they made a movie out of that. Maybe it's Green Hornet. I get the two mixed up. But Green Lantern is definitely DC.
Right. Fair enough. What do you make of some of the potential acquisition targets that have been floated for potential Netflix M&A? You said that you're happy they walked away from Warner Brothers. A lot of folks would agree with you on that. There's been reporting, though, that they've pursued Roku. Apparently, they've expressed interest in Lionsgate. There's some analysts out there saying that, you know, perhaps if Comcast does actually spin off NBC Universal, maybe that's something that Netflix should target. What do you think?
I think live broadcast is a difficult business, and Comcast is getting out of it because it's just not a profitable business. I don't think Netflix needs the headache of owning NBC. Universal different, Lionsgate different because they have libraries, but Lionsgate's library is probably bigger than anybody's. Maybe MGM was bigger. And, you know, Amazon proved that buying MGM, what was that, $8 billion or something? That was a smart acquisition because it was cheap. So I could see Netflix buying Lionsgate. I could see them buying Universal. I hope they don't get more into live broadcast. I do not think live broadcast is the solution. None of us think of Netflix for live broadcast. If they want to drive revenue, they should think of themselves as a platform for the consumption of filmed entertainment. Why can't I rent a VOD movie on Netflix? I can't. Why not? I can on Amazon. So what they need to do is they need to stop thinking the way they think and start thinking of ways to mine that nearly billion user base and sell them stuff that they want to pay for. They are doing that with games. They're going to get it right with games. They hired a brilliant guy to run it, Alonso Scon. He told me this. His job is not to make money. It's to drive engagement. He's got 1 billion people to sell games to. He's going to do that. And so I actually think they're doing the right thing, but they're not doing enough of it. And again, if they would become a platform, start putting free-to-play games on there, start putting commercial broadcast, content on there, have a free ad-supported tier that is not Netflix content, that's just third-party reruns. Run I Love Lucy in the Twilight Zone. And by the way, both of them owned by Paramount. So you could actually license stuff like that really cheaply.
I love Lucy and the Twilight Zone. Michael, I love you. We got to leave it there.
I love
Michael
you too,
Pachter,
Roman.
Managing Director of Equity Research over at Wedbush Securities. We're going to actually continue this conversation in just a bit with Evan Shapiro. He used to work at NBC Universal and IFC Sundance. Talk a little bit more. What I love Lucy and what was it? What is the Twilight Zone?
Yeah.
I don't know.
I don't know.
I mean, for people of a certain age, I mean, you know, I'm a Twilight Zone guy, but I feel like, you know,
I don't know if that would quite resonate with
a
me.
certain generation.
Yeah,
Oh,
but you know,
all right.
I'm happy for you and for Michael Pachter.
What about the Green Lantern? Were you a big fan of the Green Lantern?
I can't say that I was.
Well, I used to have the
but-
comic books.
Yeah.
So that is DC, by the way.
Yeah.
So.
I'm taking notes on all of this.
Yeah, I can tell you're very interested in
I
my
am
Green Lantern
super
story. There's some other
engaged.
stocks moving besides Netflix. Netflix down 7.5%.
Let's talk about some of them.
Yeah.
There is a world outside of Netflix. We're taking a look at shares of Alcoa, for instance, cutting its full-year alumina production forecast.
No.
There was a cyclone that hit their Australian refinery. You can see that's weighing on shares. Intuitive Surgical holding their outlook for some certain procedure growth. So you can see that's translating into an 11% drop in shares. And Coca-Cola coming out with news that its Fairlife unit was hit by a ransomware attack that is hitting shares mildly after hours. This is The Close on Bloomberg.
All right, we're taking a look at shares of Netflix here in the after-hours trade, down more than 7%, as you wait to hear directly from Ted Sarandos and company about the longer-term growth story there. The numbers for the most recent quarter, relatively in line with estimates, with some modest misses here and there. The third quarter outlook missing by just a few pennies on the EPS side and a few bucks here or there when it comes to revenue. But there are a lot of questions here about Netflix's exploration of the next leg of growth. Is it through live TV and streaming bundles to boost engagement? Let's bring in Evan Shapiro. He's the former head of NBC Universal CISO streaming service, former president over at IFC TV and the Sundance Channel, and currently a wonderful fashionista. Evan, great to have you here on the program. I've been following you for a while. You've been charting, of course, I guess we'll say the changes going on through broadcast media and the media landscape overall. You made a very prescient call, last year in 2025 about Netflix having won the streaming wars, something I don't think anyone doubts. But I guess the question is, has the kind of streaming wars evolved into something else where Netflix might need to be a little bit more dependent on live programming and other forms of engagement?
Yes, I mean, the point I was making when I said that Netflix won the streaming wars was that the streaming wars were over, and now Netflix faced a whole new challenge, frankly, from YouTube. The streaming wars were about subscriptions, and now we're in a new free TV economy. When you look at, you were talking with Michael about the share of television viewing happening in the United States, and Netflix has actually been flat for 2 years. Their engagement has either been flat or down over the last couple of years. You also talked about that with Michael. Meanwhile, YouTube has grown their share, and the free platforms like Tubi and Roku Channel, which will now be one thing, have overtaken Netflix on TV. So the point was that part of the streaming economy was over, and we were in a new era where Netflix was going to have to pivot. And what's happened is they've turned basically into TV. They are no longer a disruptive platform. They've sunk into basically becoming a digital version of CBS.
Well, okay. I'm curious, though, about this idea of them doing, it's kind of similar to what you have on Amazon Prime, similar to even what you have with some of the other platforms, Roku and elsewhere, where you have a sort of multiple channels that you can choose from rather than just the one proprietary channel in Netflix. Would that actually help them if they moved in that direction?
It's interesting. They're doing something a little bit similar to that in France. So they made a major deal with TF1 in France to basically take the entire TF1 feed and put it up on Netflix. For a very specific reason, they are losing the daily touchpoint attention war. In fact, I issued a report called the Cross-Screen Attention Index, which you can see at index.eshap.tv. And you can see that in many countries, here in the US in particular, for consumers under the age of 55, Netflix is actually losing the daily attention war to TikTok, not only YouTube. And so they are now getting into aggregation in a lot of other territories. In particular, the France example, I think, is something that's going to wind up turning into a worldwide strategy for them, which is interesting because they're really just aggregating out someone else's platform.
And so, Evan, I mean, it's interesting you make the point, it's not just YouTube, it's TikTok. I mean, what does a Netflix do? You make the point that they're falling into the trap of traditional TV. And I wonder, I mean, how do you turn that around if you think about where the eyeballs are going? Because it's not necessarily like they can go out and buy a TikTok, for example.
No, but they did just launch a vertical feed, and I think that is step one towards where they are ultimately going to go, which is verticalizing their entire library and trying to start to get the attention that they're losing when people are outside the home. Remember, most video is consumed on a phone, not on a television set. We actually just issued a report on my Substack newsletter, Media War and Peace, that showed that upwards of 60% of total attention for video happens on the telephone, not on the TV screen. And when you think about where you watch the majority of your video, it's not necessarily in the living room. It's on the bus. It's in the waiting room. It's on the toilet. And they are losing that attention war more and more every day. Yeah. TikTok is actually winning that attention war. So they're losing the free television war on TV to YouTube. They're losing the attention war to TikTok on the phone. I believe their vertical feed will be one of the ways that they try to tackle that. Imagine taking all their true crime and turning it into serialized vertical TV that you can watch in 4 or 5 minute increments on the bus or in the waiting room.
I personally would be a huge fan of that. I watch and consume a lot of true crime content, but I digress.
More so than Green Lantern, I guess?
A little bit more. Yeah, I'm glad to hear that you were watching our previous segment. But I do also want to get your perspective on the advertising business, because reading through your notes, it sounds like you're not necessarily impressed here. The analyst call has started, but in their statement that they put out, they talked about how building out the ads business continues to be a top priority, that they're on track for approximately $3 billion in ads revenue in 2026. I mean, again, you just think about the fundamentals of the company. What do you make of that figure?
Hulu will do more this year than Netflix in advertising. And Hulu has a fraction of the subscribers, and they're only in America. So that's a really bad number for them. They are terrible at ad sales. They got into it by accident because Reed Hastings announced it on an earnings call without telling anybody else, and they have failed to really transition into an ad business since then. And the main reason for that is that the culture inside Netflix hates advertising. They really do not like it, and the product is not good, and they are not embracing it in the way that they need to grow their revenue. When you look at these numbers, it's important to zoom out. When you look at the first half of 2026, and you look at net income, and you take out that termination fee that they got from Warner Brothers Discovery, or as I call them, Disco Bros, they only grew net revenue 6% in the first half of 2026, and that is why their stock is falling.
Well, I'm curious though on the ad thing too, and the comparison with Hulu though, because I mean I feel like also the content is very different. It seems like a lot of the programs that you see on Hulu are almost like on a traditional TV, so they're almost like tailor-made, at least in my opinion, for that type of ads. While a lot of the stuff that you have on Netflix, the ads aren't always natural, or they don't feel as natural. And of course, there were a lot of jokes made about the bombardment of ads that they made during the Major League Baseball home run derby. But I am curious, do you think that the content they have there is conducive to actually more ad placement on Netflix?
Absolutely. When you look at the vast majority of the usage on Netflix, it comes from the library content that Michael was talking about earlier. It's not from the originals. So put the originals aside for a second, like Gilmore Girls, Suits, these were originally on commercially supported television. They just do a terrible job of selling the inventory that they have on their platform because they don't really understand the ad business very well. They've been through how many heads of ad sales since they started? They're changing their ad stack again. This is not a good ad product, and they're not great at selling it either. They don't do a lot of branded content. And then you look at the Home Run Derby and the NFL, they're increasing their spend on live content, on licensed content, on sports. These things are getting more expensive for them quarter after quarter, which is why their net income is actually plateauing. There's the Phillies. And so they can buy all the live sports as they can, but as Seinfeld would say, can you hold on to the advertising?
Right.
It's a really hard business to compete in, and they're not very good at it. And that's, yes, they talked about $3 billion in revenue, but it's still not material enough for them to report it as an earnings category. inventory.
Yeah.
So if it's not material, then it's not important. And that's a real problem for them.
All right, Evan, got to leave it there. Really enjoyed this conversation. Hope to have you back soon. That is Evan Shapiro. He is former head of NBC Universal's CISO streaming service.
I got to find out where he got that shirt from.
Right, I want to know what brand of hairspray
I don't
he
know. I don't
uses.
think our bosses would let us wear that on air.
I don't think so, but we'll
Our
find out.
bosses, they're a little fuddy-duddy. We have ads to show. We'll be back in a moment. This is Bloomberg. The Netflix earnings interview underway right now. The company did report 13% revenue growth, decent profitability as well. Viewership up about 2%.
Yeah, absolutely. For the first half, we're getting some headlines from the analyst call right now. Netflix saying that they're making strong progress against their goals. In their view, they've reached less than 50% of their potential market, and that they account for just 5% of TV viewing globally.
But that raises the question as to how they actually get there. Ross Gerber was relatively bullish and surprised. Michael Pachter said he agrees with Ross Gerber for the first time in a while.
Love to see some harmony. Not seeing that harmony in shares after hours, though. It's still down about 8%.
We'll be back tomorrow right here on The Close, right here on Bloomberg.